Gold just had one of its worst weeks of the year, and most people watching it are asking the wrong question. They are focused on gold. But the real story right now is what this sell-off is quietly doing to silver, and what it might be setting up. Because here is what very few people are talking about. When gold falls, silver tends to fall harder. That is not a coincidence, that is a pattern. And every single time this pattern has played out in modern market history, the aftermath for silver investors who understood what was actually happening, not just what the price was doing, turned out to be extraordinarily significant. So before you make any decision about your silver position right now, you need to hear this. Because there is something building beneath the surface of this market that the price chart alone will never show you. And once you see it, you cannot unsee it. If this kind of analysis matters to you, take a second right now to like this video and subscribe to Gold and Silver Intelligence. We cover this market every week with data, not noise. Now let's get into it. Gold is currently trading near $4,044 an ounce. Just days ago, it broke below the critical $4,000 threshold for the first time since November of last year. Silver dropped to around $57.83 at its low, its weakest level in roughly 6 months. On the surface, this looks like a straightforward precious metals correction. Inflation fears, dollar strength, Fed hawkishness, the usual suspects. But here is where things get interesting. The Federal Reserve's new chair, Kevin Warsh, just delivered one of the most hawkish signals of this entire cycle. 9 out of 18 FOMC members are now projecting at least one rate hike before year-end. Fed futures briefly priced a 68% probability of a September rate increase, up from just 29% a week earlier. That is a massive shift in a very short period of time. The US dollar index climbed to a 13-month high, and both gold and silver sold off hard. But silver fell harder. In just 8 trading days, gold's ratio to silver widened from roughly 62 to 69. That number, the gold to silver ratio, is the single most important data point in this entire story, and most investors either ignore it entirely or misread what it is actually telling them. Here is what that ratio means. Right now, it takes approximately 69.3 ounces of silver to buy 1 single ounce of gold. The higher that number, the cheaper silver is relative to gold. And the lower it falls, the more expensive silver has become compared to gold. It is a measuring stick for relative value between the two metals, and where it sits right now, and more importantly, where it just came from, is the detail that changes everything about how you should be reading this sell-off. Because just a few weeks ago, in late May 2026, that ratio compressed all the way down to 54.9 to 1. When the US and China announced a 90-day tariff truce, silver surged more than 7% in a single session. Industrial demand repricing hit the market like a freight train. The ratio moved 14 full points in a matter of weeks. And then the Fed stepped in with its hawkish pivot, and in just 8 trading days, nearly all of that compression reversed. Now here is what most people miss. That kind of violent ratio reversal is not a sign that silver is broken. It is a sign that silver is caught between 2 completely different forces. And understanding those 2 forces is what separates investors who panic at moments like this from those who profit from them. Gold's primary engine right now is monetary. It is a safe haven. Central banks around the world are buying it as insurance against currency debasement, geopolitical risk, and dollar reserve dependency. The World Gold Council's 2026 survey found that a record 45% of central banks plan to increase their gold holdings this year. China's People's Bank has added to its gold reserves for 18 consecutive months. Global central banks purchased a net 244 tons in just the first quarter of 2026, up 3% year over year. These buyers operate on multi-decade time horizons. Quarterly rate cycle noise does not move them. They are structural, they are relentless, and they provide a floor under gold that the paper market keeps underestimating. But here's the part that should make every silver investor lean forward. Silver does not have that floor. No central bank has a mandate to hold silver as a reserve asset. Silver gets no institutional insurance buyer when rate fears spike. So when the Fed turns hawkish, gold gives back some ground, but silver gives back more. Because silver is fighting 2 battles simultaneously. It needs gold to hold up, and it needs industrial demand to hold up. When either one wavers, silver takes the hit first. But that is only part of the story. And the part that comes next is where the opportunity lives. Because while the paper market is pricing silver as if the Fed just broke the industrial economy, the physical market is telling a completely different story. The Silver Institute's World Silver Survey 2026 projects this year as the 6th consecutive annual silver supply deficit, 6 years in a row. The shortfall is projected at 46.3 million ounces, wider than last year, not narrower. And the cumulative draw on above-ground stockpiles since 2021 has now reached approximately 762 million troy ounces. Nearly 9 months of global mine production, gone. Drawn down into applications from which it will never return. Think about what that actually means. Solar panels, electric vehicles, semiconductors, medical devices, AI data center infrastructure, 5G build-out, ethylene oxide production. Silver is embedded in all of it, and it does not come back. The silver going into a solar panel is not recycled the way gold in a vault is recycled. It is consumed. Permanently. And the more the energy transition accelerates, the more permanent that consumption becomes. Here is where this situation becomes much bigger. COMEX registered silver inventories, the physical silver actually available for delivery through the exchange, have fallen from 531 million ounces in October of last year to roughly 315 million ounces today. That is a 40% drawdown in 8 months. Meanwhile, the paper market is trading silver based on Fed dot plots. The paper market is reading the rearview mirror. The physical market is reading the road ahead. And those two mirrors are currently pointing in opposite directions. Goldman Sachs just cut its year-end gold target from $5,400 to $4,900 on June 19th, citing the removal of all 2026 rate cuts from their forecast. JP Morgan, by contrast, held its $6,000 fourth quarter target unchanged. Those two calls sitting side by side tell you exactly how much uncertainty exists in this market right now. But what they agree on, and what every major bank agrees on, is that the structural case for both metals is not broken. It is paused. There is a fundamental difference between a broken thesis and a delayed one. Now here is the detail most people miss about the current gold-silver ratio. At 69:1, that ratio sits above the long-run average of roughly 54:1 since 1970. But it is not at a historic extreme. In April of 2025, the ratio hit 105:1. Silver investors who understood what that number meant and positioned accordingly watched silver surge 147% over the following 9 months, while gold gained 67%. The ratio compressed 45 full points, and the investors who recognized the extreme, not the noise, were the ones who actually captured that move. The question now is whether the current level, 69:1, represents a new opportunity, a continued compression, or a reset back toward higher levels. That answer depends entirely on what drives the next chapter of this story, and there are two very clear scenarios. In the first scenario, the Fed follows through on its hawkish guidance. Rates rise, real yields climb, the dollar stays strong. In this environment, gold faces pressure. Silver faces more pressure. The ratio could widen further, potentially back toward 80:1 or beyond. Silver investors would need patience. But, and this is critical, the physical deficit does not care about the Fed. The structural demand from industrial applications does not go away because Kevin Warsh raises rates by 25 basis points. It gets delayed in the paper market. It does not disappear from the physical market. In the second scenario, May's inflation reading, the PCE data that just came in at 4.1% year over year, reflects a rear-view mirror reading from before the Iran-US peace roadmap began easing oil prices. If the June PCE release in late July shows disinflation beginning to materialize, the entire rate hike narrative could unwind. Fast. And when it does, silver will not just move with gold. Silver historically reprices faster and more dramatically than gold when Fed-driven ratio widening reverses. That asymmetry is the entire story. Think about what that means in practical terms. If you are a silver investor who understands the physical fundamentals, 6 straight years of deficit, 762 million ounces drawn from above-ground stockpiles, COMEX inventories falling 40% in 8 months, this week's price action looks less like a breakdown and more like a setup. Not because hope says so, because the data says so. And here is the final layer that ties all of this together. The May 2026 silver high was $121.62 an ounce. Silver has corrected roughly 42% from that peak, but the Silver Institute's deficit has not corrected. The COMEX inventory drawdown has not corrected. The industrial demand from EVs, solar, and AI infrastructure has not corrected. What corrected was the paper market's short-term enthusiasm. What has not corrected is the physical reality underneath. Bank of America issued a scenario range of $135 to $309 per ounce for silver in their April 2026 analysis. That is not a base case. That is a scenario. But the fact that a major institution is publishing that range is itself a data point. It tells you that the upper end of what is possible for this metal, if the physical squeeze continues while the paper market wakes up to what the physical market already knows, is not a fringe idea. It is a scenario that institutional analysts are modeling. The question you should be asking right now is not whether gold falling is bad for silver in the short run. Of course it is, and we just showed you exactly why. The real question is whether the reasons gold is falling, a hawkish Fed, dollar strength, rate hike expectations, are the same reasons the physical silver deficit is going to narrow. And the answer to that is no. Those two things are running on completely separate tracks. If you are looking at silver right now and seeing only a falling price, you are reading half the story. The other half is 6 consecutive years of supply deficit, 762 million ounces drawn from stockpiles, COMEX inventories down 40%, and a gold-to-silver ratio that still sits above the long-run historical average. That does not tell you what price silver will be next Tuesday. No one can tell you that. But it does tell you what the structural setup looks like when you zoom out past the Fed noise and read the physical market the way the physical market reads itself. The paper market and the physical market are currently telling two different stories about silver. History suggests that eventually they have to agree. And when they do, the metal that moves is not the one with central bank buyers propping up the floor. It is the one that has been quietly consumed, ounce by ounce, panel by panel, chip by chip, while the paper market was busy watching the dot plot. We want to know where you stand on this. Drop your silver outlook in the comments right now. Are you reading this as a buying opportunity or a warning sign? The conversation in the comments on these videos is always worth reading. There are a lot of sharp minds following gold and silver intelligence, and this is exactly the kind of moment where a community perspective adds real value. And if this analysis gave you something the mainstream financial media is not giving you, share this video with someone who holds silver or is thinking about it. Most investors are watching the price. This video is about watching what is underneath the price. That distinction matters more right now than at almost any other moment in this market cycle. The most important thing you can do when gold falls is not panic and not dismiss. It is to understand what the fall is actually measuring, and whether the forces driving the paper price have any bearing at all on the physical reality underneath. Right now, in this market, in this moment, those two things are pointing in opposite different directions, and that is precisely why silver investors should be paying very close attention. Like this video if the analysis hit different from what you are hearing elsewhere. Subscribe to Gold and Silver Intelligence so you do not miss the next update, because the June PCE data drops in late July, and that number is going to matter enormously for this story. And share this with someone who needs to understand what is really happening beneath the surface of this precious metals market. We will see you in the next one.